Good morning. It is March 11th, 2025, and we continue on the correction of the stock market. We've had some substantial down days. Yesterday was probably the worst day of 2025, and I think it was the worst day we've had since 2020. So it was a smashing day, and smashing is not a positive adjective. Some stocks were smashed down. Speaking of Robinhood, AppLovin, some really high flyers. And I wanted to go over what the market's doing and kind of try to process what's going on. More importantly, investing's a long-term really journey. And over time, an investor can make tremendous amounts of money and build tremendous wealth. But days like these are part of the game. It's like, call it bad weather, whatever. You just have to deal with it and you have to make the most out of it because corrections and crashes are great opportunities in disguise if you view it the right way. So wanted to go over the market, see what's going on, see what lies ahead, so to speak, and try to process it all. Looks like we've got 6 people in already. Daryl, good to see you. Thanks for all your analysis on the Discord, by the way. I appreciate that. And hopefully you have some really good comments today. So if you're new to my channel, coming back to my channel, we're going to take a look at the market, but then we're going to talk about stocks. And if there's a stock that you'd like to take a look at, please put it in the chat and we will take a look at it. How do I review stocks and make decisions on stocks? So I look at a company and I want to see if it's desirable, if it's in a good industry that I like. And I think, what do I like in industries? Profits, gross margins, high free cash flows. A company that's just going to be more valuable over time. I'm not necessarily in love with their products. That's not what it's about. Like to use an example, some of my favorite movies, right? I love them, but I'm not invested in movie studios. I don't think they're great businesses. So I'll continue to be a movie fan, but not an investor. As opposed to companies like in life sciences, right? Right now they're really positioned well. They have tremendous fundamentals, great free cash flows, and it's not a drug or a pharmaceutical that I need to take, nor anybody that in my family, but it's a really, really valuable business, and those are the type of businesses I'm looking for. I do fundamental analysis. I try to break a company down principally on free cash flows. Free cash flows it's the measure that most successful investors, Warren Buffett, Bill Ackman, Charlie Munger, Benjamin Graham, they look at free cash flows to assess, is this business, what's the worth? What's the value? And that's really the primary test. I also look at earnings per share. I look at other factors, but mainly those free cash flows. And we'll go through and take a look at those companies. So looks like we've got some new people here. Rodrigo, very nice to see you. I think it's your first time commenting. And then Adam T15. Any views on Oscar's sell-off? I put Oscar on my list. We'll be sure to cover it. We'll have comments. It's looks like number 6 on the list. I'm an Oscar stockholder. Let's take a look, see if it's an opportunity or if there's something going on that we should be aware of, like some bad news. All right, so the markets, the NASDAQ is clearly in correction. It's down 12.9%. To qualify into a correction, it's 10%. This one's down 12.9. It closed yesterday and officially entered correction territory. The Russell is about the same. It's down, 13, 14%. And the Russell and the NASDAQ have a lot of technology stocks, a lot of these companies that have really seen their stock prices fly up. And there's nothing wrong with stocks being more valuable, nothing. But there is something wrong with stocks that flew up just really irrationally. Stocks that flew up 600% in 6 months. That's just really hard to believe. Maybe the fundamentals are good. And there's always like a good company behind these stocks that have just flown up. There's always a good company. There's a good story. But again, we got to measure cash flows. What is that business worth? And potentially, what's it going to be worth if they continue to execute and be successful? So we'll take a look at each company and put them through that, because the NASDAQ is telling us it's selling off because there was a lot of frothy stock prices. Now, what's causing the market to be scared? Well, economy-wise, the tariffs that have been introduced is a policy change, and the policy change is going to shock the system at a minimum. It's already shocking the system. We have tariffs, and we have back and forth tariffs now being exercised, and the language or the comments on both sides, it's escalating. It's getting worse. It's not getting better. Now, a good solid tariff battle may accomplish some things long term, but this particular live stream and this channel focuses on stock investing. So we want to really focus on how's it going to affect stocks. It's going to really hurt stocks in 2025. If we stay in the current environment where we have tariffs, these tariffs are going to really, if anything, be super noisy, disruptive. Headlines are going to be very negative. It's just going to drive up a lot of fear. It's going to cause stocks to really sell off, especially the stocks that there was an expectation that they were going to grow at very high rates. It's going to be hard to grow if there's a lot of unknowns, indecision, if you have a contracting economy. So the tariffs most definitely are the principal policy change that's causing a lot of this angst, fear, concerns. Interest rates are dropping. Interest rates are dropping because in the way I process that, the chance of recession is much higher now, and we may enter that recession here in 2025. A solid recession is going to correct stock prices. Now, the market is not efficient at all times. It overcorrects and it overshoots the mark. When you look at the market, it overshot the mark in 2021, went too high, and then it corrected in 2022, went down substantially. The NASDAQ went down a lot in 2022, went down 34%. That's a pretty good haircut, man. That is a buzz cut. And then from there, it decided, let's do this. Let's rocket up stock prices again. And look how clean that line is. If you were to draw a line, that's a pretty nice chart. We're talking 2 years in a month and a half, and the NASDAQ's up 91%. So the prices to me are a little frothy. They're a little frothy. Over 5 years, up 121% as a whole index. So if we have a pullback, and you see how steep this pullback's been, it's not like totally surprising. We had a similar pullback. This one's steeper back here in 2024. This one I think did measure 13%. So this one pulled back. Some stocks got nicely priced. I remember buying Amazon in these days. It was nicely discounted. A bunch of nice stocks were discounted, created an opportunity. So right now there is an opportunity to buy some stocks. It's beginning to, the downward momentum in the market is pricing some companies where they're now at a discount. And I started buying into AppLovin yesterday. If you follow my channel, I've done videos on AppLovin for months, and my videos months ago were like, this stock's overheated, it's priced too high. Well, the stock's been cut in half. It's gone down 50% in the last 4 weeks. Well, I always said it was a great company, and I started buying in yesterday. So um, that's an example of a stock. You know, when you have this type of price action and corrections, you're going to open up our opportunities. But we got to do our homework. We got to value the companies. We got to see which companies are the ones that we desire when the price is right. Once the price is right, be ready to act. So good stuff on AppLovin. I'm going to review that stock and I'll share more details there later. The S&P, what is the story with the S&P? Is it officially, so it's at 9.44%. And the way they measure these corrections is it has to close 10% lower, and then it's officially a correction. In this case here, it's right now operating at down 9.44%, and we'll see what happens. The market's selling off. It's down. I think yesterday was so big that I don't know that there's a lot of selling going on because I think all the selling happened yesterday. I don't think there's a lot of buying, which is why we're seeing stock prices fall. So it's a really good day to buy stocks, by the way. I put in all my buy orders before I started this live stream. And I'll tell you which stocks that I bought. All right, so the indexes are down, and that's the big general story. When we look at a heat map, what is interesting, when I glance at the heat map, what I found surprising is there's a couple green spots. I'm like, why is there green? But Meta's up, Amazon's up, quality. Tesla, I wouldn't put Tesla in quality category, but these look good. Nvidia's up. I mean, it's been smashed. It's down to 100 and I'm gonna call it $8, $110 per share. Broadcom is up. Palantir's up. Salesforce is up. Nice, very good. Walmart's up. Netflix is up. So there's some green out there, and there's some pretty brilliant red. Like Apple's down substantially, and Apple's the most valuable company. So when it goes down, it takes a lot of the index with it. Telecom's down. That's interesting. Home improvements down. So this is all discretionary, right? So if we're going into a recession, they're not, people aren't going to go remodel their kitchen anytime soon. They're going to be conserving money, and they're not going to go to restaurants as often. I'm not quite sure why telecom is down. That tends to be kind of a good space during recessions. Interesting. So it was a little surprising to see that, the heat map, it's not a consistent color. And in some sectors, like in industries like semiconductors, you have some green and some red. Over here in discretionary, you have one green, a couple greens, and mostly red. So that was interesting. Financials are down. Visa, MasterCard are down. We have a recession. Not as many transactions are going to happen on their network. So that makes sense. Okay, that makes sense. I can go along with that. Okay, so let's take a look at how sectors are behaving, which sectors are doing the best today. It looks like materials is the only sector in the green. Everything else is in red. Materials, utilities is a place to seek safety during times like these. Consumer discretionary is right there. Technology, not a bad day. I think we saw Nvidia was doing okay. And energy's there, communication services. And healthcare is in the worst spot for the day. Interesting. So there's a lot of red. There's only one green. Year to date, which sector? Healthcare is 5.93. That's the number one sector for the year. That's about 2.5 months. And then materials, consumer staples, real estate. Real estate's been doing well because interest rates have been dropping. As interest rates drop, real estate becomes more attractive. Builders, developers of real estate can take loans at a lower cost, so that's good for them. And we've got utilities, energy, technology. It's getting its kind of its face ripped off. But I have no sympathy. I have a lot of technology stocks. It's the number one sector for the last 5 years. Lots of money has been made in technology. Lots of money will be made in technology going forward. So we don't have to look at this and use any of our emotions. We just are rational investors here. All right, so that's going on there. The big stocks, the big names. What's going on? Well, Apple is not having a good day, and they are in correction for the year. Microsoft is keeping its stock price close. Nvidia is up, Amazon is up, Google Alphabet is down again. They've had a tough 2025. Google Alphabet is discounted, in my opinion. It's a good company. And Meta, it's good to see Meta is up. It's green for the year. It was up 25% earlier this year. So it's given up a lot of those gains and having a good day today. Berkshire's really been rocking, really consistent. And boy, doesn't Warren Buffett look like a genius with all that capital he has ready to deploy in the market. Now, we call it kind of a cash pile for Warren Buffett, but we know that he's in bonds. He buys short-term bonds, and he's making a yield on those bonds. And those bonds are going up in value, by the way. When interest rates drop, bond values go up. I released a video on bonds this morning. Take a look at it. I know most of us are just pure stock investors. I get that. But I think bonds could be used to diversify, and bonds can be used to keep some cash out there, some resources and capital ready for times like these, just like Warren Buffett. The Oracle from Amazon, he's got all that capital waiting for some of these companies that are great companies to be priced so attractively that he cannot resist, and he goes in and buys them. Broadcom is up, TSM is down, Eli Lilly is down. So that's what's going on with the big names. Mike, the dividend investor guy. So you sold your MDB and started a position on Oscar. Man, you picked a nice day to go into Oscar. Nicely done. Let's take a look at M, and that's Mongo. I mean, we don't have to look at it. I think we've looked at it a couple of times over the last couple of weeks, and boy, Mongo's just gotten shellacked. But now you're in Oscar, and you're back in the hood, or I should say, you're back in Robinhood. I love Robinhood, man. I think that the price decreases on Robinhood, I couldn't resist. I bought more Robinhood. I think the business is a real good one. They're unique in their business plan. They're going into really good fertile spaces that nobody else is dominating, and they get there first and they make it happen. So I really like that stock. So we'll take a peek at these symbols, Mike. We'll look at Oscar, we'll look at Hood, and we'll even look at Mongo. Just take a peek what's going on there. And what are your thoughts on BDCs as a whole in this market? So help me out there. BDCs. What does that mean? BDCs. I'm not understanding that. If you can give me a little more there. Okay, cool. Business Development Corps. Thank you, sir. And I don't have anything just off the top of my head. But let me think about it. All right, so let me catch up on comments, and then we're going to start getting into some stocks, see where we can find some good opportunities. And looks like Ian Rosenstein, thanks for joining. What do I think about Zim? You know, Zim is in a kind of an interesting spot. We covered it yesterday, and the management team's looking to acquire the business. We'll take a look at it, see what the stock price is going. Carlos, very good to see you. Your dollar cost averaging and buying the dip. Nicely done. That's what I do. That's what I do. Nice. And, you know, I can tell you in 2022, it was such a prolonged correction that I did run out of capital. And I just kept getting more like creative, like, well, maybe I can sell that one stock. Maybe I can do this. Maybe I can do that. And it was a good idea. I mean, we're early on this thing, so hopefully, you know, we'll see how long this correction lasts and so forth. But good luck out there. Good to see you're in the game. Here's another comment I'll put out there, right? You got a market that is doing this on us, right? And some people, I don't think it's anybody on this live stream because you guys are investing in yourselves. You're trying to become a better investor. But some people freeze. They're like a deer in the headlights and they just stop in the middle of the road and then they get smashed by an 18-wheeler truck. Okay, it's not the time to freeze. Yeah, it sucks to have like a day like yesterday where like Robinhood went down 20%, AppLovin went down 12%. I mean, I can go down the list of these shocking price decreases, and we were following 3-4 weeks of, you know, price decreases. It's not that time. It's actually the time to increase your awareness, to kind of increase your concentration on your plan. You know, how are you going to grow your wealth? Because this is like we're hitting pay dirt. We're hitting prices that are going to be very good investments. So it's not the time to freeze. It's actually the time to do more analysis, to really get into your stocks, really have a good plan. So I'm glad that you're in it to win it, Carlos. Hang in there, buddy. So we're going to look at Zim. They report earnings tomorrow. So Daryl, so Verizon announced softer subscriber guidance, huh? Interesting. We'll take a peek at that one. And I guess that affects them all if people are like turning off their phones. You know what's interesting is I'm traveling and sometimes I get in a bad area and I can't text with my wife and we can't communicate really well. But then we get on these free apps like WhatsApp and the signal's better, the communication's better. So back to Verizon, maybe a lot of people are like, hey, you know, the heck with these premium plans that cost money. I'd rather just get me on a network and I can WhatsApp with people all day long. And they go to the least expensive option that they have because they don't need a signal in all places. Especially, I'm on one of the best carriers, and my signal in certain places is terrible, and I'm like paying top dollar. So it's like, what's wrong with that picture? And I have to get on a free service to get a decent decent conversation going, especially video calls. WhatsApp works far better than my FaceTime. So Apple's got to fix that. Genetic Smite, good to see you, man. Doomy Trash, what's happening? So Daryl, Verizon's company's CRO, warned he expects Q1 results to reflect softer consumer demand. Yeah, greater competition. You know, who's that actor? He started, I think the company's called Lime. Ryan Reynolds. He started a freaking mobile phone company, and I think it's going well. So yeah, talk about competition. You got to compete against that celebrity. Elon, you're on TLT, huh? Okay, good. Very good. All right, so caught up on that. Boy, we got good comments. Thanks, everybody. We're 28 strong on the live stream. I'm sure we're going to hit a really high number. I'm going to collect all like the symbols that you guys are interested in, and then we're going to start rocking. So Daryl Main and ARCC, two names, two symbols that I'm not familiar with. And GDS. GDS, is that guidance systems? All right, so BDCs, we're talking. Okay, cool. Thank you, Mike. We'll take a look at those. Looks good. Good stuff. All right. Yeah, thanks, Daryl. Daryl, keep the comments coming. All right, let's start rocking, everybody. Yesterday, we went over like 36 symbols, and I'm going to try to pace myself because I was like going so fast yesterday. I ended up going like an hour and 45 minutes, and then I was kind of done. So I'm going to try to go at a little slower speed. Maybe I can hang in there. All right, so just real quick, we're going to look at AppLovin. AppLovin is up 5%, and that's after they really went down. They've been going down substantially. And again, with AppLovin, I always recognize them as a solid business, just really good business with great, terrific growth, great profits, 44%, growth on the top line. And you look at their gross margins, just beautiful gross margins at 75%, generating cash flow above $2 billion. So $2.1 billion. So that's just a terrific business, but the market just got crazy about the AppLovin stock. I mean, come on. It cannot rise. This is just unnatural for a stock to go in a matter of like 6 months to go up 600%. So I became concerned. I'm like, this is a great business. I missed the move, but it's just overpriced. And I put my, valuation out there, and now it's come down. It's come down more than 50%. And it made the stock attractive. And right now, I think it's discounted by 28%. So the stock in short order went from being too expensive, was priced too high, to now being discounted because of that decrease in price. Now, the stock price is not the company, and the company is not the stock price. AppLovin as a business has been a terrific business at all times. For the last couple of years, they've just been killing it. Their growth shows it. Customers want to do business with AppLovin. So it became an opportunity, and I took advantage of it. I bought shares yesterday. The stock rose today. I bought more shares today. And there is an example of opportunity comes up during these sell-offs where, stocks are just being decimated, and it creates an opportunity because I really believe in the AppLovin business. And I said that on all my videos, even though I said AppLovin was priced too high, it's just, it needed to be corrected. Well, the market took care of that. It really lowered the price, and I'm glad that I started buying into AppLovin. All right, let's take a look at some of these BDCs that Mike, the dividend investor guy, wanted to look at. So Main Street Capital Corporation is a business development company specializing in equity capital, lower middle market companies. Okay. So they're like private equity, huh? And this is a $5 billion company. Year to date, they're down over the 1 year, 22% appreciation. Dividend is almost 7%. Forward P looks really good. And the revenue growth looks decent, but it's slowed down. It was growing really nicely for 3 years. Then the most recent year, it came down to 8% in growth. They have gotten bigger. Maybe there's fewer deals out there for them to go out there and work on. Now, I can't value this company on free cash flows because they're more like a bank or a lending institution. But I am curious to see what is their book value and has it been expanding? Have they been creating more value for this company? So the book value, 23, 25, 26, 29. Yeah, book value is expanding. Looks good. So book value is expanding. Four analysts cover it, $62, $44 is the range. So it's priced a little bit expensive according to analysts. Now these here, I'm always, I, you know, one of the things that I want to do in my investments is I invest in companies that I understand and I feel like I could make a really good decision on. Companies like these are in so many investments that are not like clear or easy to understand that I find it hard to understand. Are these guys really doing well? Are they really going to, flourish? And on this one here, I just don't have a frame of reference to be able to provide that type of opinion. So I usually don't invest in these guys. It has to be a little more clear to me. And let's take a look at their website. Maybe they explain it well on their website. So they help private companies grow and transition by providing flexible private equity. Okay. Mm-hmm. Yeah, these guys are doing that. Yeah, it's not an investment I can make, and I can't give a solid opinion, unfortunately, on these. It's never been an investment that I've really warmed up to because I'm really giving capital to somebody who's then making decisions, a team that's making decisions on which projects they're going to fund in private equity. If these guys have a long-term track record, which they do, that's a pretty good rate of return with a nice dividend. Maybe you establish a really good comfort level with them, and you have a lot of confidence in them, and you're comfortable investing in them. Maybe that's the plan there. But it's not the right investment for me. I like really understanding the business and being able to make a good decision on the core business and look at the fundamentals of that core business. These guys are not like that. They're in 200 different businesses right now. They're providing capital for maybe an expansion project for one company, a buyout for the next one, an acquisition for the next one. I mean, it's kind of a hodgepodge of what they're investing in, and they're making these decisions. But it's just not intuitive to me. So that would be what I'd talk about there. So the next one is ARCC. Now, Ares Capital, I am familiar with. They're in Los Angeles. They invest in businesses very similar to the one we just looked at. My opinion remains the same. I've looked at Ares over the years. I'm familiar with them. And you see their market cap, it's not like a tremendously high market cap. It's not like, hey, they were 10 billion 5 years ago, now they're 50 billion or 100 billion, like AppLovin, right? AppLovin, that business is a business. We know these guys do a technology solution to help marketers online get the best return on investment from their marketing. And their market cap just flourished, right? Their market cap is 5 times greater than it was a year and a quarter ago. That business is worth a lot more. I understand the business. I can make a good decision. These guys are invested in like 100 different little businesses. So it's like, okay, you're a lending company, but you're not a bank. So it's harder to get my head around what you do as a business. Now, I've never gotten the comfort level for Ares to be able to invest in the company. And my comments are very similar to the other stock we looked at, Symbol Maine. So I'm not a tremendous help to you today, Mike. This is probably an area that I'd rather disqualify myself as an investor versus trying to give you, off the cuff comments. And this one looks like it's the same type. So good luck with these. And maybe someday I can learn from you on why these investments are really worthwhile. Thanks for asking about those. Now, a business that I do understand is MongoDB, excuse me. And these guys here, man, they're up 6.81. Hopefully you sold and made a little bit of money there. And it's $15 billion market cap. Now, the problem that we saw with Mongo over the last couple of weeks is their growth is not overly exciting, and they're a small company, so they should be growing faster because they're competing against massive software companies. In order for them to be successful, they have to become more relevant. And that was my big problem with them. And then the cash flow they produced just wasn't high enough. $120 million just doesn't do a lot for me. I can value the company maybe at 4 billion, maybe 5 billion in market cap, and it's up at 15. So the stock's been really hammered this year, and I just don't see how the stock's going to rise anymore unless they really expand that growth. Again, AppLovin's growing at 41%. Their revenue's just shooting out of a cannon, and their cash flow and profitability are far better than MongoDB. Those are two companies that are technology companies. They're creating software. They're selling it as a SaaS solution. But you can see the fundamentals of AppLovin are very different than MongoDB. So that is MongoDB. We'll see how that stock trades. Over the last 5 days, it's not been a pretty picture. 5 days down 25%. Holy smokes. That is not fun to ride that train. So that was MongoDB. We talked about AppLovin. A stock that's out there that I really like is Zscaler. And I've been buying into Zscaler. It was up 4%. Yesterday it was down. I mean, just about everything was down yesterday. But over the last 5 days, it's up 7%. It had very good earnings. It came through and had just excellent earnings. The growth of this company is really good, 27%, $2.4 billion of revenue overall. Their gross margins are 78%, really good free cash flow. So overall, I still see a nice discount in Zscaler. So I've been buying into Zscaler. I bought more shares today. I bought shares yesterday when it dropped in stock price because that was a great opportunity to pick up some shares at a really nice discount, especially since they just announced their earnings and they showed that, hey, they were doing really well. The value of this company based on their free cash flows is really high. Those cash flows are really valuable. So the discount on Zscaler to me is really attractive. And just to kind of give you guys a quick tour for everybody who's new, is I value companies on free cash flows. I put together a quick forecast in my model here, and then I discount those cash flows that I expect in the future to today's value. And Zscaler has an intrinsic value of $52 billion, but the market cap's only 30 billion. So it has a nice discount when you compare the value of the cash flows to the stock price that it currently trades on. So that's why I've been buying into Zscaler, and I think it's going to work out. I think they're going to have a good year. Part of why I think it's going to work out is over the past year, this stock hasn't risen much. Over the 5 year, it's done fantastic. I mean, it was on a rocket ship ride, and then it settled down. But over the last year, it hasn't been all euphoric like a lot of other stocks that have been so darn expensive. So this one here is, I think it's a good opportunity for me. I'm going to keep buying. I bought more shares since the stock rose because it showed that, hey, investors are interested in this stock. It went down a lot yesterday. I forgot how much, maybe 6%, and then it bounced back. So that was a good signal for me, and I bought shares yesterday. I bought shares today in a DCA technique or process that I should call. So that's Zscaler. Somebody asked about Oscar Health. Boy, talk about having a bad day on a Tuesday, down 7% over the 5 day. It's down 4%. That's not too bad because yesterday was kind of a bad day for everybody. And this one didn't do too bad yesterday, but today it is not doing well. Oscar is a high growth health insurance company, and they focus on small businesses. So they're not trying to compete with, the United Healthcares of the world. They're trying to really pick that spot of small businesses and individuals who want healthcare. They're trying to do a good job there. Year to date, the stock's up 7.5. Now, this is an investment that a couple of super investors are into. Most notably, Michael Burry is in it, as well as Viking Global Investors. But Michael Burry is in this. Michael Burry's big into healthcare right now. So a lot of things that I like around Oscar. I like their growth, 56% revenue growth looks excellent. And I like that their business model, they're focused on an area where they can really do well. Elevance, United Healthcare, the big guys, they're going after big populations, the big employers, where you have Oscar really wants to go after that small business and that individual. And I think there's a lot of business for them to close out there. They can really become a substantial size. So I really like that direction they're going in from a business perspective. And I like that they're generating free cash already. I love their growth. Overall, this is a nice looking small stock. It's $3.6 billion in market cap. Forward P is only 19 and they're growing really well. So I like that a lot. High growth with a low PE, sign me up. Sign me up. I'd like to be a part of that group. And here, Oscar, I use a higher discount rate since it's a smaller company, but even when I discount those cash flows that I expect out of Oscar Health in the future, I get a value of those cash flows that's 105% higher than their current stock price. That's just a fabulous opportunity. When I can look at a business, it makes sense to me. I've been investing in health insurers for a long time. I was a long time United Healthcare stockholder. It went really well. United Healthcare rose year after year after year, and then it got a little expensive, so I sold it a couple years back. And healthcare hasn't worked all that great for a couple years, but now it's bouncing back. It's number one sector for 2025, and Oscar Health is part of that sector. I like their business plan. I think they can really operate and do well in that small business, small individual marketplace. The big guys are not going to mess with them. They might even acquire Oscar at some point and say, these guys are doing such a good job, we'll acquire them for 10 billion or so. And then they'll pay all us stockholders a nice premium when they acquire the company, potentially. So Oscar looks good, looks really good. What's it doing today? This is a small cap. So let's see if there's any headlines out there. The most undervalued small cap, but there's one big risk. Well, what's the big risk? Oh man, they teased me, huh? Let's see here. We got to close that guy out. I guess I can't read it. You have to have a description, subscription, not a description. So there's always bad news if you look for it. I've looked at Oscar. I understand their business plan. I think I'm good with it, and we'll continue to buy shares. I bought shares today. Put my buy order in before I started this stream. Happy to buy shares at a 7% discount. Thank you very much, stock market. I appreciate you giving me that coupon, that buy one, get two for free kind of like coupon. So this guy, this is a good stock. I think it's going to do well. It's good to have some small caps. Now, small caps, when you have a big sell-off, it's gonna be harder on the small caps. They're a lesser known name. Investors are not as confident in small names. Are like, wow, I know who United Healthcare is, but I don't know who Oscar Health is. So they sell it off like, hey, I don't want any chances right now. Okay, cool. I don't want to take excessive risk right now. So they sell off Oscar Health. And that's what's going on with these small caps. They're selling off hard. Now, if it sells off a quality business, I'm a buyer. I'm a buyer in a small business that has a lot of quality, a lot of potential, and is going to expand my wealth. Put in 10 grand in Oscar, wake up 5 years from now with 40, 50 grand is my expectation. Because if these guys make it happen, this valuation, they're going to go from a market cap of 3.6. I wouldn't be surprised if we wake up 5 years from now and it's worth $20 billion. That'd be a handsome reward to stockholders. So we'll see how things work out. Remember, everything I share is just an individual investor. I'm never recommending you buy, hold, or sell any stock that I cover. I'm just sharing my opinion on companies. So let's keep rocking. So looks like Daryl is on the assignment. And he's saying Oscar risks include potential changes to the Affordable Care Act subsidies under future administrations, which could disrupt Oscar's current business model and force a shift to ICHRA. Okay, that could definitely be a problem. I know that individuals, when you get insurance right now, depending on your income level, you pay a different amount. So if you don't have a lot of money, you can buy health insurance at a very affordable price. If you make plenty of money, you're paying full price. So that's what I think you're referring to. All right, so we covered Oscar. Now let's talk about what's the next one. Somebody talked about Robinhood. Boy, Robinhood got shellacked yesterday, making a comeback, up 4%. Nicely done, Robinhood. Get off the mat. You got knocked out yesterday. You got knocked on your back, but you know what? You're going to stand up and go up in value. Year to date, the stock's flat, but man, this has been a winner. Winner. If you look at the 1 year, it's up 118%. And I was hoping to go a little further. And actually, this is why I like the Google Finances. It lets me kind of pick a point in time on this chart and then kind of show you that this thing has really rocked. It has really worked. At one point, it was up 7 times your money in about a year and a half. Now it's only 3.5 times your money. Either scenario, that is a win. A win is a win is a win. So it's really pulled back. Look at that pullback. Bam, coming back down. Now, this pullback is pretty severe, and I think the market just gets kind of nutty sometimes. When you look at the appreciation in this stock, in the course of less than what looks to be, call it 2.5 months, the stock went up 80%. That's just too much too fast. Too much euphoria, too much exuberance. And it's now paying the price. It's down over the course of, less than a month. It's down 43%. So not a big surprise. What goes up really fast will come down really fast in some cases. Now, Robinhood's a valuable business. It is really valuable. I like how they're unique. They do their thing. They don't follow, the business plans that, brokerages have been following for 50, 100 years. They do their own thing and they drive great free cash flows. I think their cash flows are worth a lot more than the current stock price. And now with the stock price having been lowered, I am buying shares of Robinhood. I bought shares yesterday. I bought shares today because it lowered the price. And I was beginning to get nervous because I actually invested like 20,000 into Robinhood. And at one point it was worth over $100,000, like $110,000. And I'm like, when we were seeing that euphoric chart, I'm like, I sold some of my Robinhood. I banked it. I rang the cash register. Well, now I'm buying some shares back because now that the stock price has come down, I'm like, I want to own some more Robinhood. It's a good company. I like what they're doing. They have a unique proposition in financial services. They keep expanding the products they sell. That's a really good idea. They're not just one trick pony. They continue to diversify, which is why I like them more than like a SoFi or even I own Coinbase, but I like Robinhood more than Coinbase because Robinhood is more diversified. Coinbase is kind of a one-trick pony. So I like Robinhood. I'm glad I bought some shares. Looks like some people were invested in Robinhood and were interested in talking about it. So that is Robinhood. They're up today. Good to see that. What's going on with the market? Let me take a quick peek. See if the market's going to. Nope, it's still kind of where it's been, right? It's still S&P is down almost 1%. Nasdaq is there. Heat map probably hasn't changed much. Yeah, it's still kind of like the same. And stock sectors are probably going to be the same as well. All right, so let's keep moving. Let me just go down the list of stocks that you guys want to look at. Somebody want to look at Zim, and Zim has earnings coming up, right? Now, management started talking about taking the company private. They're going to announce their earnings tomorrow. Now, shipping companies don't get a very positive valuation. This company's made so much freaking money over the last 5 years. They've made well over $2.5 billion in profits in cash. But the market just doesn't value shipping stocks and make them go, to greater heights, like let's say a Google Alphabet or a Meta or a Microsoft. It just is what it is. It's a shipping company. I think they're a terrific business. They generate great profits and cash flows. They pay a humongous dividend, but I don't know if they're going to do that again in 2025. They're growing really nice. Looks like the shipping rates are going their way. And these guys revamped their shipping fleet. They bought new ships when they made a bunch of money during the era of the supply chain issues where there was shortages of product due to COVID. And they made so much money back in those days that they took that money and bought better ships, which was a very good idea. Cash flows are really positive. Look, cash flow is 2.5 billion and the market cap of the company is 2.5 billion. That's 100% rate of return on cash. You don't see that in other places, but that's the shipping industry. The market doesn't really value shipping companies all that well. It gives them really low PEs. It's always expecting that this is cyclical and it's going to have a down cycle and wipe away all profits. So that's where Zim is at. You got to pick Zim, and I've been a Zim investor. I made good money on Zim. But in my opinion, when you buy Zim stock, you also have to define at what point would you sell. Are you going to expect to maybe make 30% and then you sell? And on the flip side, if it goes down more than a certain percentage, maybe if it hits 20% to the low side, do you sell? Because you see the stock goes up and down. So you got to pick the right spot. I bought around here. It got to a certain level. I got out, and I don't think I missed much. I got out, somewhere around $20 a share, and it's trading at around $20 a share. So remember that. Now I had a buy order on Zim. I had it down to I think $17 a share, close to it, like $17 and a few cents. And it never was getting close. And once I heard the news on the management team thinking about taking it private, I canceled that buy order. I'm like, I'm going to kind of sit on the sidelines and get through this earnings call, get more information and see what's going to happen with Zim. Zim's a good company. But the market's just not going to value shipping companies like they value other companies, like a technology company as an example. So we'll see what happens tomorrow. All right, so Shadow Guy. Cool. Good to see you, Shadow Guy. Let me know if you want to see some stocks. Let me keep rolling here. I think we had Verizon come up, and that was kind of like some bad news on the subscriber growth. Did Verizon announce their earnings? Nope. They came out and said subscriber growth wasn't as good. Okay. So that's what drove the stock down. Wow, that's a big drop. And they were doing kind of well, right? Yeah, they were doing well for a while in 2025, and now they gave up a lot of those gains. Yeah, the thing I don't like about Verizon and AT&T, and I'm not sure about the others, is they carry a lot of debt. When you look at their debt level, it's just too high. You look at their debt, $171 billion of debt. Oh my God, it's a lot of debt. Now, interest rates are dropping, but it's still too much debt. Debt to EBITDA is 3.15. And when I look at a company like this, I'm like, okay, the market cap's 180, but they have almost as much debt. It's like, why do they need so much stinking debt? They have to, I get that they have to put a lot of, assets in the field for them to connect everybody. But geez, it's not a very desirable business in my book if you have to put that kind of money into the business. So I'm not in Verizon. I'm not in AT&T. I just think their balance sheets are not good, and I'd rather not deal with them. So, so that is Verizon. Interesting what's going on out there. I know they I think some investors like it because of the dividend. I'm not purely a dividend investor. I think dividends are okay. Nothing wrong with them. But I'd rather see good appreciation. Instead of a dividend, I'd rather see a stock double, every 4 to 5 years. And you don't pay me a dividend, that's fine. I can sell stock and, create some cash if I ever needed it. So Verizon, that's what's happening with Verizon. All right, so somebody who's in TLT, and that's the 20-year Treasury bond ETF. Nicely done. What's this thing done? Let's see here. Year to date, It's up 4%, and you get this dividend. You get a 4% dividend. You made 4% appreciation in the current year, right? So if rates continue to drop, this ETF is going to continue to go up in value. Meanwhile, the stock market's really going down in price. So this is a double winner. Stability, income, and you got an appreciating ETF price. So looks pretty good to me. It's right up there. If you look at my bond video that I created today, I showed 3 examples on 3 ETFs. One was a short-term ETF, one's an intermediate, and one was a long-term. The long-term is kind of like this one here. The reason I went with Vanguard is Vanguard has lower fees, and this is a fine example, good example. Very similar. I think the Vanguard one had a yield of 5.7, and this one has a yield of 4.14. So check it out. Check out my video. See, maybe you get a few ideas for yourself. So nicely done on that tilt. Hopefully you have a few bucks there. You're making some good money on bonds. Now, a stock that's been doing really well is Chubb. And Chubb is an insurance company. Today it's down a little bit, but yesterday it was up. And for you to be up yesterday, that's standing up tall. Yesterday was a really tough day, but these guys are getting it done. For the year, it's up 5%, and they pay a tiny little dividend. But I think this stock is really discounted. This is a nice performing stock, but it hasn't kept up with Allstate and Progressive. Progressive Insurance has done really, really well. Now, when I value Chubb, I just see a fantastic company in the form of fundamentals. So when I look at fundamentals for Chubb, I actually think they generate so much darn cash. I mean, their cash generation is massive, like software company level, technology company level. So that really catches my attention. Insurance companies drive a lot of cash because they write policies. Somebody says, I want to insure my home or my car or my business or this or that or the other. Well, they have actuaries that will do the mathematics and, manage risk and then sell an insurance policy. Well, the insurance company collects the money in advance, and then they will have to pay out on certain claims, right? And it's usually less than the overall money they collected. Now, so they make a profit on the policies they sold, and they get that cash. They get to work with it. They get to put it into short-term bonds. They get to invest it and make money on it while they're holding it. So they win 2 ways. It's a really, really good business. No big surprise. Warren Buffett, he liked it so much he bought all of Geico, and that's part of Berkshire Hathaway. So, and he's an investor in Chubb. So Warren Buffett's an investor in Chubb. Other super investors invest in Chubb. Let's take a look and see who those super investors are. So Chubb is owned by 3 super investors: Warren Buffett, Torrey Funds, and then Christopher Davis. So it's on the radar of some super investors, and it's on my radar. I bought more shares of Chubb. I like the business. I think it's going places. I think it's really showing good stability. It was good to have a couple of stocks do well yesterday, even though it was such a terrible day. Chubb was one of those stocks that stood up tall. Nicely done, Chubb. It's a stock that I'm building a position on. I did really well with Allstate. I've got a nice position in Allstate. I don't think that's going to go anywhere, but I'd like to build one for Chubb because I think they're undervalued and they're going to do really well over time. All right, so let me check on comments here. I think I'm caught up. Yeah, I think I'm caught up on comments. Let's take a peek here. And so I'm just scanning the comments. Bear with me, trying to catch up. It's always tough to jump back in and see where I left off. Tomas Blinus, very good to see you. Thanks for joining. And then CIT PEX, you want to look at NBIS. Okay, we'll take a look at that. We'll put it on the list. And then we've got Omar. I don't own Google. Let's take a look at Goog. It is discounted. And then we've got Daryl. So yeah, so SCHQ is similar to TLT. Very good. Yeah, there's a couple of options there if you want to be an investor. All right, good to see you, Shadow Guy. Thanks, Daryl. Good to see you. And then Rodrigo, GDS. That's right. Didn't I write that down? GDS. Did I not write? There it is. Sorry. There it is. GDS. I'm going to hit GDS first because I think you've been waiting. All right, GDS. All right, so GDS Holdings, together with its subs, develops, operates data centers in the People's Republic of China. Okay, so this is a data center company. $7 billion market cap. Over the 1 year, it is rocking, up 480%. Year to date, it's really doing well. So China's really working now. Now this one's a tiny cap, and investing in China in a small cap is risky for me. Let's take a look. So their growth rate is unimpressive. I mean, data centers should be growing really fast. This one's not growing really fast. So what's wrong with this picture here? Why aren't they growing any faster? So they're growing at 12%, and this is in the Chinese currency, okay? So CNY to USD 0.14. So, and this is in millions. Okay. So this is like a 1.5, $1.6 billion revenue company. That's really small. And then we go to free cash flow, and they're burning cash. And their margins are really low, 20%. I've looked at this business before, and it's a pass. The margins are not good. The free cash flow is never going to be that great. People are investing in China, and the big story is that DeepSeek really made a lot of headlines, and now Alibaba with their AI solution is making a lot of headlines. All that makes sense. This one here is a huge risk without a ton of reward because they're burning a lot of cash, but their margins are really low. See these margins? These are gross margins. They don't make any profit right now. The gear they have to put in these data centers is really expensive. The money is made on having cloud services like from Microsoft, Azure, or AWS from Amazon. Those guys make a lot of money, but these guys are a data center operator. That's not where the money's at. So this one's a total pass for me. Super high risk. People are taking this stock to greater heights. It is a small cap, but you look at the valuation, man, this was worth a lot. It came back down over the 1 year. It is up 483% because China started to work. And this stock went from $10 up to $40, $50 in no time. So that's a lot of euphoria. A lot of euphoria. A lot of, wow, this thing's going to be bigger in the future. It might be, but it's not all that profitable. Not a lot of cash. I'd rather go buy other businesses. I'm a big Alibaba stockholder. I also own Futu in China, and I own an ETF that invests in China. And I'm good with that. This one's too high risk for me. What did it do yesterday? Out of curiosity. It's tough to say. So that is GDS. It is a pass. I would not buy it. If I owned it, I would sell it. So thanks for asking. Somebody asked about NBIS. And this is Nebius Group operates as a technology company that engages in building full stack infrastructure to service the global AI industry. Its businesses include Nebius, an AI-centric cloud platform built for intensive AI workloads. Okay. So the AI businesses, right, they were flourishing for a while, but now it's like not so much, right? See, like this one here. Wow. That is wild. 5.9 billion, revenue is low. They lose a lot of money, man. They're losing a lot of money. Look at the revenue contraction. What's going on here? What happened here? Maybe we got to you got to go look at the financials. This is not a business I want to invest in. It's just too early. They're trying to go into the AI space and kind of build data centers that are going to be an AI play, but AWS is already there. Microsoft Azure is already there. I mean, there's plenty of competition, and more competition comes up every day. Is this one going to work? Maybe, but it also has a pretty good chance of being a total loser and a big money loss loser for me. So I'm going to avoid it altogether. I already own Amazon and I own Google, so I'm good. Yeah, I'll be a part of the AI, industry. Companies that want to take their AI workloads over to Google Cloud or AWS. I'll be making money since I'll be a shareholder in those two companies. This one here, it's just too much risk. And I think the whole AI story has lost a lot of its magic because it was more of a fairy tale than anything. I think we're realizing that, hey, there's no real AI business out there where a company's making a lot of money. So if there's not a lot of money to be made, then why are stockholders all that excited about AI? Maybe in 10 years, the world's going to be very different. There's going to be some really valuable businesses out there, but we don't know which ones are going to be those types of businesses. You think about OpenAI and ChatGPT, that was the cat's meow 2 years ago. Now there's like 20 competitors, two big ones from China in DeepSeek and Alibaba. And now OpenAI's got competition surrounding them all over the place. They're not as special anymore. And that's going to continue to happen in AI. And we'll see who ends up being the winner and the loser. It's going to take 5-10 years to figure that out. Between now and then, I think these investments are just have too much risk, not enough reward. So thanks for asking about NBIS. Somebody asked about Google. All right. Google Alphabet is discounted. Now, these guys, they have no momentum. They've been selling off. I think they announced their earnings and they said, hey, we're spending a lot more in the data center. And stockholders did not like that. They want to know that, hey, you're going to preserve those awesome cash flows that made you that valuable. So when you restate their cash flows, they've been selling off. And I do believe that they are discounted really nicely. So Goog is a nice discounted stock. And at some point, this stock is going to begin to work because they just have too many valuable businesses like their search business, YouTube. They have their Waymo business. They have their cloud business, right? So they have a lot of awesome businesses. So they got to hear the message that stockholders told them around the excessive capital expense in the data center. Like, hey, pump the brakes. Don't waste so much money. You got to preserve some of that free cash. And hopefully they get that signal and they continue to grow their business because their businesses are awesome. So Google Alphabet's a good one, a real good one. I'm a big Google stockholder, and that's how I see Google. So thanks for asking about Google. All right. All right. Let me check the chat and then I'm going to go on like a 5-minute break and I'll be back. Let's take a look here. So CITP SITPEX 2000 CLG. All right, you'll be the first one when I come back from break. And if anybody else wants me to evaluate a stock, put it in the chat. I will evaluate it. I'm going to take a quick break. Let me put up a banner, let everybody know that I'll be back in a few minutes, and then we will reconvene. All right, so all right, guys, I'll be back in a few. Hang tight, and I'll be back with you soon. All right, everybody, thanks for bearing with my little break there. Let's get back into it. Let's touch base on the market really quick, see what's going on. Looks like the market is selling off even worse to some extent. The S&P is down further, and look at the S&P. If it closes at this moment, it's near correction territory, almost there. Just a little more oomph, and we're in correction territory in S&P. The Nasdaq's already in correction territory. That one's correcting, should get to better prices, but you know, all that could be good news. It could be very good news. So let's hang in there. So it looks like we're going to look at CLG as the first stock. And anybody who's out there, if you want to talk about a stock, let me know. Put it in the chat. Let's talk about it. Let's talk it through. Let's look at the fundamentals and see what kind of investment we have on the table. All right, so let's look at I keep seeing KLG. So WK Kellogg operates as a fast food in United States, Canada, Mexico, the Caribbean. Manufactures, markets, distributes ready-to-eat cereal products primarily under Frosted Flakes, Special K, Fruit Loops. So this is a consumer staple. Consumer staples have been doing better. This one's up 18%. Over the 5 year, it's up 46%. When you see, this one was a spinoff, I believe. Yeah. And it's a $1.8 billion market cap company, $2.7 billion of revenue. Forward P is 13. Growth, not a lot of growth. These companies, they don't grow a whole lot. They're just growing a tiny bit. And that's an example there. When we look at their free cash flow, they don't have any free cash flow in the trailing 12 months. But last year, we were at $272 million of free cash flow. Now, let me take a closer look and see what kind of CapEx they have to put back into the business. Because if these guys are making cereal, they probably have these factories, these plants where they make cereal, right? So let's take a look. So the statement of cash flows will have cash from operations, and then CapEx. And you see this, I don't like this. The amount of capital you have to put back into your business is higher than the cash it produces. I don't like that. If you look at a very desirable business like an AppLovin, they don't have to put much capital back into the business. They just make a lot of profit and a lot of cash. These guys don't. These are not businesses that I like, these consumer staple businesses, for that reason. Now, stockholders love these dividends, but companies like these, in my opinion, market their stock by having a dividend. And some people will own it. That's fine. They can own it. I don't have to own it. And this hasn't been around a long time. It's been around for a year and a half, and the stock's up 1%, even though it's had a really nice rise lately, right? These stocks tend to be move sideways. They maybe go up 10, 20% over 5 years, and they give you a dividend. That's not good enough. That's not good enough for me. I want nice appreciation. I want my cake and I want to eat it too. Give you an example. A better stock in that space is Kroger. Kroger over the 5 year has doubled my money and it paid me a dividend. That's what I want. Why is Kroger doubling my money and paying a dividend, and it has everything that I'm looking for? Well, they don't have to put a ton of capital back into their business, and they have terrific free cash flow. Very good free cash flow. That's the big difference between the KLG and Kroger, is that these guys make a ton more cash. They don't have to put a bunch of capital back into their business. and their stock continues to flourish. This is really good, consistent appreciation. I'm happy as a stockholder, long-term investor. I really think highly of the company, and will continue to own stock. This is my single consumer staple stock. This is a good producer of wealth creation. I'll continue to invest in them. So good luck with KLG. Those are my comments there. And I have a couple other stocks that I had brought to the conversation. Let's take a look at those. One of them is ADMA. ADMA came up in the live stream over the last couple of weeks. It's really doing well today. Year to date, it's flat. Over the 1 year, it's up 169%. What do these guys do? So they are ADMA Biologics. It's a biopharmaceutical company, engages in developing, manufacturing, and marketing specialty plasma-derived biologics. It's treatment of immune deficiencies and infectious diseases in the US. So it's a biotech, high-tech company. I should say biotech, biopharma company. And they're a $4 billion market cap company. The revenue is 426, forward P of 24. Their growth is awesome, 65%. Wow, that looks great. Free cash flow is out there. It's not here, but it's in their financial statements. It's not showing it on stock analysis. Overall, ADMA became a buy stock for me. It started in a live stream. I analyzed the company, decided to buy shares, and I like that rise today because it's been really rising nicely. The cash flows are going to be worth 73% more than the current stock price. So I really like that about them. Overall, it's a discounted stock. And this is a small cap company that has terrific growth. You know, if this was a tech company, investors would go berserk about it. If you would have said, hey, this is an AI data center company, boy, this thing would be worth 100 billion. But no, this is a biologics company, 4 billion. Their profits are great. Gross margins of 51%. Not as great as I thought, but they're okay. Their cash flow is good, and their growth is phenomenal. So I'm glad I'm buying into this one. See where we're at here. ADMA. Recently, it's gone up nicely, 10% since February 25th. When did they announce their earnings? They announced earnings last week. So they had an announcement, and the stock has been going up since then. So that's good to see. Good growth, good company. So that one looks good. Looks real good. Let me take a look at New Holdings. New Holdings is a growth company down in South America. It's up today. I think it was down substantially yesterday. So what's going on with New Holdings? So year to date, it really came off. I think the earnings came out and it really sold off. It's really sold off over the last 5 days. It's come up today, but it sold off yesterday along with a lot of other stocks. So right now, I'm a New Holdings stockholder, but I'm not buying any additional shares. I'd like to get some more information. I'd like to see what the market's going to do with stocks down in South America. This one here is for the year. It's kind of in the red zone. $49 billion market cap. They are a nice growth company. They continue to grow in South America, and they operate like in Mexico and Colombia, Brazil. So New Holdings is growth company down in a region where I have few investments. I think I have 2 investments down there, Mercado Libre and New Holdings down in Latin America. We'll see how they do. So New Holdings, good to see that their stock's up today. Speaking of stocks, what's the stock market doing? Man, it looks pretty darn red, but then when I look at the heat map, I see some greens. So Stocks, yeah, it's getting worse, not better. Meta's now negative. It was up 1%. Amazon's down. It was up earlier. So the sell-off is accelerating. We may have another significant down day. Not as significant as yesterday, I don't think, but don't hold me to that. Maybe the market gets all angry again. So right now, the S&P, I'm going to guess we are nearing that 10% mark. 9.98. Just another little nudge. If somebody else sells one more share, boom. All right, so we're in a correction. So Mike, I almost sold my ELV pre-market because it was up 430. So Elevance. All right, so Elevance for the year is up nicely, 14%. It's working in 2025. Elevance is a health insurance company similar to Oscar Health, but it does, health insurance for big businesses. And in recessions or in down markets, these stocks tend to hold their value well. Here's an example. It's up almost 3% on a day that's pretty cruddy. And I think yesterday this stock did well. I think it was in the green. So look at that. In the 5-day, we've been kind of like dealing with a forest fire on the primary NASDAQ exchange. And these guys have been going up in value, which is why I like having Elevance in my portfolio. These guys are doing well. I think they're going to do well in 2025 because everybody needs health insurance. These guys provide it, and they provide it at a very good profitability and free cash flow rate. They always have been that way. United Healthcare, Elevance, they really make a lot of money. These guys are doing well. When I value the company, Elevance has a nice discount, and I think they're going to continue to get better. And I know that the new administration is going to remove a lot of the barriers to businesses, and it might help Elevance quite a bit. These guys are discounted substantially, and that's after they've had a nice rise in 2025. Part of the reason why they're so discounted is the years of 23 and 24, health insurance payers didn't do all that great. So there's kind of a low starting point, and it's really rising from a low starting point, and it's a good, stable industry to be a part of, given the times that, the stock market is selling off a lot of these tech stocks. So pretty good idea. Elevance. I bought more. It's a big, expensive share price. I bought more Elevance today. So I bought more into it. I bought into the strength, and I'm dollar cost averaging as quickly as I can into healthcare. It's leading the pack. I think it's going to continue to do well, and I'm moving capital into that space from cash as well as selling a couple positions. Like I'm selling Nike. I did a short on Nike. I'm creating some capital there, and I'm selling Hewlett Packard HPQ, creating some capital there. So moving from one stock to another, as well as deploying my cash. What is Nike doing? I think it was down quite a bit. Yeah, it's down 3%. I sold at the open, so I did good by selling, and I'm DCA selling my Nike stock, selling out of it, and probably over the course of a week or two, I'll be completely out of it. I'm almost out of HPQ. I've been selling it for about a week and a half. Ever since their earnings announcement, it just was clear that tariffs are really hurting HPQ. And tariffs are the main reason why I'm selling Nike. I think tariffs are going to hurt Nike, and I'd like to get out of that stock. All right, guys. So that is going to be it for the stream. Thanks, everybody, for joining. You guys take care and good luck.